Welcome back to the channel. Today we're diving deep into Michael Burry's 2025 Big Short and what his latest portfolio moves reveal about the state of the markets. If you know Burry from The Big Short, you know he's not afraid to go against the crowd. And this year, he's making some of his boldest bets yet. We'll break down exactly what he's doing, why he's doing it, and what you can learn from his contrarian approach. Warren's Money Buffet emphasizes that it is not a tax, legal, or investment advisor. The content is purely informational and not associated with Warren Buffett or Berkshire Hathaway. Here's what we'll cover in this video. First, a quick overview of Burry's 2025 Big Short and why it matters. We'll recap who Michael Burry is and why his moves make waves. Then, we'll analyze his latest portfolio, what changed, and why. We'll separate media hype from reality. After that, we'll break down his biggest bets. We'll look at where he concentrated his portfolio. We'll discuss the risks of copying Burry. Michael Burry, renowned for foreseeing the 2008 housing crash, is a contrarian investor whose strategies defy market norms. His fame surged with The Big Short, showcasing his deep research and high-conviction bets. Currently, Burry's portfolio, managed under Scion Asset Management, includes diverse assets, reflecting his unique approach to investment. Now, let's look at Burry's 2025 portfolio. He's made a dramatic shift, selling almost all his long positions and loading up on puts, which are bets that stocks will fall. Over 85% of his portfolio is now in puts, with Nvidia as his biggest short. The only long position left is Estee Lauder. This is a massive pivot, signaling Burry's conviction that tech, in particular, is overvalued and due for a correction. With headlines screaming Big Short 2.0, it's easy to think Burry is calling for another 2008-style crash. But the reality is more nuanced. The media often frames Burry's moves as a simple bet against the market, igniting fears of a repeat crash. But his hedge fund, Scion Capital, is only a portion of his total portfolio. He also holds substantial investments in farmland and water rights, assets known for stability and resilience, even in downturns. These real assets don't appear in 13F filings, so the public only sees part of the story. Understanding his full asset allocation is crucial to grasping his true market stance. Let's talk about the 13F filing, which is where most people get their info on Burry's trades. The 13F only reveals a partial, delayed snapshot of his public U.S.-listed securities. It misses his personal investments, foreign holdings, and key details like option strike prices or expiry dates. There's also a lag. By the time we see the filing, it's already months old. So, investors and media are often reacting to outdated data, missing the broader context of Burry's real asset investments and timely trades. Why is Burry's biggest short against Nvidia? Nearly 50% of his portfolio is in Nvidia put options. He's making a major bet that the AI-driven rally is overdone and vulnerable to a pullback due to rising competition and slower adoption. Nvidia surged past the S&P 500 but shows signs of plateauing and volatility in 2025. Burry's strong bearish conviction here is classic contrarian thinking. He's betting big that the market has gotten ahead of itself. Michael Burry's bearish stance on Chinese tech stocks, including Alibaba and JD.com, stems from ongoing United States-China trade tensions and tariffs. These factors, coupled with slowing growth and regulatory pressures, create uncertain profit outlooks. Burry's put options reflect his view of overvaluation amid macroeconomic headwinds and geopolitical risks, anticipating potential market corrections. Burry's portfolio has gone from diversified to laser-focused. He cut his holdings from 13 to just 7, concentrating on a few high-conviction shorts. This mirrors his 2008 strategy, signaling a strong bet against what he sees as market bubbles. Concentration allows for bigger bets on fewer positions, showing strong conviction, but it also increases risk and potential volatility. For most investors, this level of focus would be nerve-wracking. But Burry is no stranger to betting big when he sees opportunity. Despite all the bearish bets, Burry doubled his position in Estee Lauder. The stock has suffered an 80% drop from its peak, but Burry sees it as undervalued and poised for a turnaround under new management. This is a classic value play, buying when others are fearful and waiting for the rebound. New leadership and restructuring efforts could drive long-term value growth, and Burry's increased stake signals confidence in a recovery. Here's what sets Michael Burry apart. He allocates a significant portion of his personal wealth to farmland and water rights, real assets that have historically provided stability and steady cash flow even during recessions. For example, farmland investments typically generate returns in two ways. First, through the appreciation of land value over time. Second, from income produced by leasing the land to farmers for crops or livestock. Water rights are another key part of Burry's strategy. These give investors access to a critical and increasingly scarce resource and can generate steady income by leasing water usage rights to agricultural or industrial users. If you're not a billionaire, you can still access these assets. Farmland REITs. For instance, companies like Farmland Partners or Gladstone Land own and manage thousands of acres, paying dividends to shareholders from farm rents. Crowdfunding platforms. Sites like AcreTrader and Farm Together let everyday investors buy fractional shares of real farmland, sharing in both the income and appreciation. Direct ownership. Some investors buy farmland or water rights directly, though this requires more capital and expertise. Burry's approach is all about balance. These real assets help offset the volatility and risk of his high-profile stock bets. By holding farmland and water, he hedges against market downturns and inflation, making his overall portfolio more resilient and diversified. Following celebrity investors like Michael Burry involves risks. His high-risk tolerance and complex strategies, supported by stable assets, aren't easily replicable. Delayed 13F filings mean outdated information, and rapid trade reversals can lead to losses. Without understanding his strategy, retail investors risk poor decisions. Careful risk management is crucial when considering such investments. In 2025, Burry's strategic focus on Chinese tech stocks like Alibaba, JD.com, and Baidu resulted in substantial gains, with Alibaba rising 40%. This contrasts sharply with the Standard & Poor's 500's 5.45% decline. His $33.6 million investment in these stocks grew to $41.9 million, showcasing the effectiveness of his contrarian approach amid mixed results from other tech giants like Tesla and Nvidia. Michael Burry's contrarian investing style in 2025 focused on undervalued Chinese tech stocks, achieving significant gains despite a challenging United States market. His strategy emphasizes deep research and conviction, buying when others are fearful. This approach aligns with Warren Buffett's advice. Be fearful when others are greedy, and greedy when others are fearful. But let's be clear, this strategy has risks. Shorting stocks can lead to unlimited losses if the market moves against you, especially in volatile sectors like tech. Timing is critical. Markets can stay irrational longer than you can stay solvent. Poorly timed trades can result in severe financial damage. Always weigh the risks before trying to mimic a high-stakes contrarian play. So, what can we learn from Burry's moves? Don't blindly copy celebrity investors. Their risk tolerance and resources are different. Diversify your portfolio to manage risk, rather than concentrating in a few positions. Look beyond sensational headlines and filings to understand the full context of an investor's strategy. Identify contrarian opportunities where market sentiment is overly negative, but fundamentals are strong. Most importantly, timing matters. Even the best strategy can underperform if executed at the wrong time. Now, I want to hear from you. Do you agree with Burry's bearish stance on major tech stocks and his concentrated portfolio approach? Share your perspective in the comments. If you found value in this deep dive, like the video and subscribe for regular updates and market analysis. Let's build a community that learns and grows from diverse viewpoints. Michael Burry's 2025 portfolio decisions have sparked significant debate. His bearish stance on major tech stocks and concentrated portfolio approach challenge conventional wisdom. Engaging with these contrarian strategies can deepen understanding and foster a community of informed decision-makers. Share your perspectives and subscribe for regular updates on market insights and analyses of influential investors like Burry. Thanks for watching.